Good morning, everyone. Welcome to the Lumsden McCormick webinar, An Election Storm, an update to the Paycheck Protection Program and tax planning for 2020. My name is Maria Gambacorda, and I am the Director of Marketing here at Lumsden McCormick. Before we get to introductions, I'm going to quickly run through a few notes. This webinar is being recorded, and we will share a link with all attendees once we get it on our website shortly. We are offering 1 hour of CPE credit for this webinar. Therefore, all polling questions and survey questions need to be answered. We'll have 4 polling questions. You'll be prompted for each. And at the end of the webinar, a short survey will automatically launch. Again, if you're requiring CPE, completing the polling questions and survey are required. Both chat and Q&A are enabled, so we welcome your interaction. Corey Van Duzen, as you see, is on the call, and he'll be monitoring that and advising the presenters of questions that come up. If you do require CPE, if you could email me, and I'm going to submit my email in the chat. The slide deck will also be provided if you want to refer back to it. That will be emailed to everyone after the session. As well, we have some related technical articles on our website, and I will share all of those in the chat as well. Before we get to introductions, though, I want to launch our first poll. And so I just launched it. So if everyone could please respond to it. Oh, I'm liking these numbers. Overwhelming. It's a victory for the Bills and Josh Allen. Give it a few more minutes. We've got a lot more people signing in. All right, it looks like 81%. So thanks to everyone for participating. So, and hopefully we'll be able to get in the stands if we can get out of this yellow zone. So, all right, Corey Van Duzen, he is a tax partner here at Lumsden McCormick, has been here over 15 years. He started with the firm right out of college, Niagara University. And his focus is on taxes for businesses with a focus on business development incentives. So Corey, I'm going to turn it over to you.
Thanks, Maria. Want to welcome all the clients on the phone, referral sources, friends of the firm, and anyone else that is looking for some education and 100% stone cold answers on what's going to happen with our government. No, I'm just joking. We're probably going to have lots of qualifications and not give anyone answers, but no, we'll give everyone our best guesses and try and provide some further clarity into what's going on after the election results that we have and the ones that we don't have and that we're still waiting on. So with that, I'm going to introduce our panel. We basically have 2 teams of panelists today. One team is going to be handling mostly PPP questions, our favorite subject. And luckily my children are at school today because they outlawed the word PPP at my house. They don't want to hear it anymore. The PPP team is going to be Megan Morris and Jenna Torella. Both are managers. Megan is a manager in the tax department. And Jenna is a manager in the audit department. So we got a little tag team here going cross-departmental on the PPP. We also have Cheryl Jankowski and Bob Ingrassi. Cheryl is a partner in the tax department that specializes in family wealth planning, estate and trusts, whatever buzzword you want to call it. And she's an excellent resource and is going to be talking about some of the stuff that you can do headed into year end. Bob Ingrassi is a principal in our tax department as well. And I think I hired Bob. I remember he was working at the bridge at the liquor store when I met him, and he's a Niagara University grad as well. And he also specializes in family wealth planning. So with that, I am going to try and shut up now. But like Maria said, text or chat or whatever you want to call it, put your questions up there. And my job is going to be annoying to the panelists and interrupt them all the time and ask your questions and make sure they get answered. But in all seriousness, if any questions don't get answered, email us, call us. A lot of this stuff is new. If you want to bounce ideas off what you should do going into year end, because it is going to be a little bit of a conversation between you and your advisors on exactly what levers you should pull going into year end. So with that, PPP team, I think you're up first.
We are. I will take it away. As Corey mentioned, PPP, everyone's favorite topic. We're going to get into a little bit of the forgiveness application options, some updates, and then tax and financial statement presentation. So to go through some of the highlights of the forgiveness application options right now, and again, always subject to change, there are 3 options for your application. The first being the 3508 form, which is the full detailed forgiveness application. This was the original that came out. It's going to take you step by step through FTE reductions, any salary reductions in excess of 25% by employee, and then also any of the safe harbors that you may be able to apply for and reduce that hit on forgiveness. This application is going to be the most detailed, require the most amount of documentation to be submitted, and again, all of those calculations. So really the most cumbersome of the applications. The next that came out is the EZ application. So a little bit easier. There are some qualifications that have to be met in order to use this application. There's 3 different criteria. The first being that the borrower was self-employed, an independent contractor, or a sole proprietor. The second, that the borrower did not reduce annual salaries or hourly wages for Q1 2020 compared to the covered period, and that would be anything in excess of 25% for any one employee. And as part of that second criteria, the borrower did not reduce the number of employees from 1/1/2020 through the end of the covered period. And then the third qualification is that the borrower did not reduce annual salaries or hourly wages, similar to criteria 2, and that the borrower could not operate at the same level of business as compared to 2/15/2020. And that would be based on any government mandates, OSHA requirements, things like that. So there is less documentation that's required to be submitted with that application, but we do want to note that a lot of these calculations and documentation is required to be maintained. So if the SBA or the lender does come back with any questions, you will have to have that documentation maintained. And that's really just proving that you were qualified to submit that EZ application. And then the last is the 3508S. So that is the newest application that came out. It is a simplified forgiveness application for borrowers who received loans under $50,000. So this will be the least amount of documentation required to be submitted. It's really just a certification that the borrower used the funds correctly for the right purposes in the right period. It does require some documentation to be submitted, but significantly less than the other 2 applications.
Can I interrupt? We had a question, I believe, related to form 3508 EZ, the EZ form. The question is, do you have to meet all or one of those qualifications that you mentioned for the EZ form?
It would just be one. So there's the 3 options, and you only have to qualify for one of them to be able to submit the EZ application. So then the last thing on here is just a reminder that the forgiveness application is due 10 months after the end of your covered period. So there is time to apply. There's no need to rush the process. Take some time, gather all of the documentation. You do have some time to apply. And I'm going to turn it over to Megan.
All right, so I'm going to go over, a couple updates that have come out. I think our last webinar was in early August that we did specifically on PPP. So here's just a couple of updates since then that we're going to walk through. So basically, The first one is concerning related party rents. So basically early on, there was a lot of confusion as if you had rent and a lease with a related party, whether you could deduct those rent payments and include them in your loan forgiveness application. In the end of August, some guidance came out that basically said you can only claim rent expense up to the amount of mortgage interest paid for that particular property during the covered period, as long as the lease existed before February 15th, 2020. So, and for this, any common ownership between the business and the property owner is considered to fall under this related party rule. So it unfortunately, for a lot of our clients that don't have any debt left or any mortgage left on that property, is kind of a harmful limitation there, because now we can't pick up any of those rent expenses into your forgiveness. As well as with this, mortgage interest documentation will need to be provided to the bank to support the amount claimed. And if you have multiple, tenants in the building, so say you have your related party owns a big, commercial space that has a couple of different tenants, you won't be able to take 100% of that mortgage interest. You'd only be able to take, 50% if you're using 50% of your building for your PPP borrower rent expense. That's all you would be able to claim. Kind of moving on. So for owners, there's specific rules for PPP that they can only claim up to $20,833 if you're using a 24-week covered period for eligible compensation for forgiveness. However, the SBA came out and clarified that under 5% or less than 5% owners for corporations, they are not subject to this limitation because they don't have a meaningful ability to influence how PPP loan funds are spent. So they're subject to the normal compensation rules for all of the other employees. This ruling did not address LLCs or partnerships specifically. It would just focus solely on S&C corporation owners. Next slide, Maria, please.
I'm going to interrupt for a second. We did have 2 questions come in.
Okay.
It goes back to forgiveness on the first one. Is there a benefit to apply for forgiveness in 2020?
So right now we're actually going to discuss this in a couple slides, but basically our guidance to clients is pretty much to wait. There's not really a benefit unless there is a reason, to apply right now, like whether you're having a change in ownership or there's some major reason. There has to be a why to like rush to apply right now. But we'll get into that in a little bit more detail in a little bit.
We do have another question on Form 3508. Are companies to report gross wages excluding company share of Social Security and Medicare per payroll reports on the amounts of net cash paid per bank statements? The question is in the chat. If Jen and Megan, you want to look at that and reread it.
No,
Yeah.
you don't exclude it. It's they're asking if you take the amount that comes out of the bank account that doesn't include the tax withholdings on the wages. You do not exclude that.
Okay, we got another one here, and it is, our holdings co-owns the building with no mortgage. Can we include rent by an affiliate?
So basically, if there's any related party type relationship, for PPP purposes, there has to be a mortgage and you can only claim forgivable expenses up to mortgage interest. Sometimes these company structures can get complicated with who owns who and what's related and not. So if there's like a more specific question, it might be easier to kind of take it offline after and we can address a specific situation. But basically, once there is any sort of related party interest, there was no safe harbor granted of certain percentages or anything like that. It's subject to these rules.
Okay, and oops, we have one more. As far as the PPP application is concerned, we have been told that the government's portal is not yet ready to accept the PPP loan forgiveness application. Would you be able to confirm this?
I believe it is available now, but it had been slow to be available. Some banks had actually started accepting forgiveness applications before it was, but I believe it is open now. But some banks have been a little bit slow, which is kind of going to coincide with what we recommend too, where we don't really have all the guidance yet on this. You know, guidance is still coming out and constantly changing. So there's no real rush to worry about applying right now.
Okay, I will move forward then. Thanks for all the questions, everyone.
Okay, so kind of moving on again. So guidance concerning changes in ownership. So this is kind of a little bit of a specific, you know, situation, but they did come out with guidance for if, you know, since you've applied for PPP, you've had a change in ownership and what that means. So for purposes of this, a change in ownership means that there's at least a 20% change in ownership in common stock. If you transferred at least 50% of the fair market value of your assets, or if you were merged into another entity, that is the test to kind of what would be considered a change in ownership for this purpose. So depending on your change in ownership, you might or might not need SBA approval, but also you should just kind of notify your lender prior to the change in ownership. So basically, kind of if this applies to you and you're considering having a change in ownership, you're already in agreement, make sure you reach out to your bank, reach out to us, and we'll work with you to address kind of your specific situation. I think in cases where we've seen this, most of the time we're working to kind of get that forgiveness application submitted and get it approved. That way it doesn't slow down any sale or anything like that and create any potential issues. Now,
Megan, just a question on that. If we delay applying, when is payback started?
so you have 10 months. So you have to start paying in 10 months and you have 10 months to apply from the end of your covered period.
There was also somebody chatted in the chat that M&T had already given them forgiveness. So that was interesting. I didn't know anybody had gotten forgiveness already.
Yeah, we've had like one or two where it took about 3 weeks for M&T to process it and turn around and get forgiveness. But M&T also did kind of a tiered application structure. They only opened up actually almost about a month ago, about 3 weeks to everybody. I'm not really sure if the turnaround has slowed down since it's opened up for everybody or not. All right, so for the good faith certification. So earlier this year over the summer, the SBA announced that loans over $2 million would be subject to a more detailed review upon submitting forgiveness applications. And last week, you know, it kind of came out that some borrowers were receiving a loan necessity questionnaire from their lender after they submitted the loan forgiveness application. These questionnaires, there's 2 of them, one for for-profit businesses, one for nonprofit businesses. They can't be found on the SBA website. You can Google it and find, you know, articles, and we can even send you the draft questionnaires, but those, in our knowledge, are not really official yet. They haven't been officially finalized by any official source or posted really on the SBA website.
We got another question that came in. What is the length of the covered period?
So your covered period is either 8 weeks or 24 weeks from the day that your PPP funds were deposited into your bank account. So that's when that clock starts. Most of our clients are going to probably be using the 24-week covered period. So for a lot of our clients that got in and applied right away, your covered period usually ended sometime in October. So you still have basically until August to really have to worry about applying for forgiveness and actually getting that application in. Okay, so for the $2 million questionnaire and certification, so this questionnaire will still be sent even to borrowers if they receive less than $2 million, if they're part of a controlled group that received over $2 million in the aggregate. There's a question basically that you have to certify when you apply if you're part of a controlled group that received more than $2 million. So for our clients out there that are a little bit worried about this, we're going to be reaching out to you. We're going to be working with you and providing additional updates as they become available, because as I said, kind of right now, you know, even though there are drafts of these questionnaires, they haven't really been delivered through official channels. They're just kind of something that's come out on the internet.
Meg, you got a question on this. Do you recommend that the questionnaire for the $2 million applicants not be submitted to the bank?
So you are going to wait. This questionnaire will be given to you by your lender or the SBA once you submit your forgiveness application. So probably what we'll end up doing, and I mean, this is very new, it came out last week, and we're advising a lot of clients to wait. So there might be more guidance that comes out in the future, but we'll probably start to take a look at this, questionnaire when you do get it. The questionnaires that have come out, they had to be returned, I think, in 10 business days once they were received. So we probably, once we submit your application, might look at drafts, or if official one comes out, and start to think about that. But you don't have to submit it until your lender gives it to you, which is after you submit your forgiveness application. All right. So additionally, just recently, it's been ruled in court that the SBA will need to disclose the names of and loan amounts of all PPP borrowers who received the funds. So over the summer, they already, reported borrowers' names and loan amounts for any loans over 150,000, but it has just come out that they will be doing that for all borrowers that received PPP funds, just to disclose to the public. All right, are there any other questions that we have right now? We're good?
Yes, we do have one more. Actually, we have two.
Okay.
If I receive my loan on a Thursday, April 23rd, and my payday was the next day, Friday, April 24th, do I count from April 24th or the next week, which would be May 1st? The April 24th pay date was for the week ending April 17th.
Okay. So for when you're computing forgiveness for PPP, if you have weekly or bi-weekly payroll, you can choose the alternative payroll covered period. So what that would do is that would start with the first payroll period after you get your PPP funds. So I don't remember the dates that Maria said, but whatever the first day is of the next payroll after you get your PPP funds, if you have bi-weekly or weekly payroll, you can choose that. So your covered period only for payroll costs would be based on those days. Your non-payroll costs, so your rent, your mortgage interest, your utilities, that would still be based using your, I think it was April 23rd date. You said there was another question, Maria?
Yeah, I got this one. Well, you got this one, but I'll read it to you. Why delaying the app? Because this is a really good question. Why delaying the application since we need to know the actual amount of forgiveness by our year end 12/31/20 to determine the non-deductible expenses?
So yeah, so we're probably going to talk about this a little bit. So right now, they are non-deductible expenses. However, there is potential that legislation will come out that these are deductible. So that's kind of why we're recommending to delay. It makes it very difficult to plan because we don't really know the timing, and I'll kind of get into this. It might be easier if we just sort of talk about this on the next slide, because that's kind of where I'm headed. We don't have a lot of guidance yet. So that's why we're kind of advising to wait. There's no real harm in waiting. So Maria, I don't know if you want to jump to the next slide, and there probably will be more information I speak about.
There was actually another question to follow up on the SBA.
Okay.
When you mentioned the $2 million the $2 million application, it says, if it's not official from the SBA, should it be submitted?
So you wouldn't submit the application until you get one from your lender. So there's been one that's kind of circulating on the internet that says SBA on it, but it's not actually, you can't find it on the SBA's website. So that's why we haven't really sent it out to people. If it comes time where we need to submit that application, we can kind of look at that to plan, but we're not going to recommend that you submit that unofficial application until you get something from your bank or something from the SBA. So I just wanted to I know it's a little bit confusing that there's that questionnaire out there, but it's nowhere on the SBA website. There's kind of rumors or some speculation that it's not finalized, that questionnaire. So just be hesitant, if you see that and you read it on your internet, just wait. There's no real need to rush right now. So now we have a polling question about if you already applied for your PPP loan forgiveness.
We'll give it a few more seconds here. All right, I'm going to end the polling and share the results.
Okay, so it looks like, yeah, the vast majority of you have yet to apply for
That adds up to 101%. Sorry, I couldn't resist.
Corey, the accountant over here. All right, so Maria, do you want to move on to the next slide for me, please? All right, so now we're going to get into the tax return. So basically, as it currently stands, the amount of your PPP loan that is ultimately forgiven is currently taxable to the borrower. This is through a disallowance of expenses. So basically, it's going to be in your deductions on your tax return that this ends up coming through, but it ultimately just means that the loan is currently taxable to you based on this IRS notice that they came out with. This was not the legislative intent behind PPP. So this is subject to change. It is possible that Congress will pass legislation to correct this. Actually, it already was passed as part of the HEROES Act, which kind of died in the House and didn't really end up getting anywhere, but there is possibility that this will change in the future, kind of once the fallout from the election happens and we start getting back to looking at passing another stimulus bill. So additional clarification is still needed to kind of determine when these expenses would be non-deductible from your PPP loan forgiveness, as to whether that's when the expenses are paid or incurred. So during that covered period when you've already spent those funds, is it when you submit your forgiveness application, or is it when your forgiveness application is ultimately approved by your lender and the SBA? We don't really know that answer yet. Basically, the IRS just kind of came out and said they would be disallowing the deduction for those expenses. So that's why, you know, we're kind of advising that planning for PPP forgiveness timing is critical, but we're really not seeing any harm in delaying submitting that application because there really isn't guidance yet as to how this will be determined. And I guess it's one thing I wanted to just clarify too, is I think there's some confusion with forgiveness, that forgiveness is first come, first serve. You know, we kind of had this mentality when PPP came out that we had to rush to apply. Otherwise, you know, all our funds were gone, and the first round of funds did disappear really quickly. So it was important that people got in and it was kind of a free for all to get the money. That's not the case with forgiveness. You know, you have time to sit there. We have time to wait and kind of see as some of these applications have been submitted and get feedback from the bank about, you know, additional errors and stuff that they're seeing that are common, you know, mistakes. So that way we can put together a comprehensive, complete application where there's really no issues. So there really is not any harm in delaying applying. All right, so that's kind of all I had right now on tax reporting for PPP. Jenna, do you want to jump in and talk about financial statements?
Before we move ahead, we have a couple questions. Corey, you want to go through those, please?
Oh, yeah. Sorry, falling asleep on the job. First one is, if between lender and SBA, they have 5 months to decide, again, the tax deadline is 4/15/2021. Isn't it better to apply now instead of waiting for legislation? All right, Cheryl, are you getting into any of the theory on year end? I don't want to steal thunder, or I can comment now.
You know, Corey, it never hurts to touch on something twice, so go ahead and share your thoughts.
All right. So these questions are really, really good. And we had about a 2-hour brainstorming session within the firm, partners, managers, principals, audit, tax, and because we didn't know what to do at first. And I think the answer is there aren't any real concrete answers. One of the variables was what is going to happen in the election. Well, we now have a proposal for Biden winning, and I think a lot of networks are calling him president-elect. So we know he's won. Now the next domino to fall is the Senate, and if the Senate is controlled by the Republicans, then tax rates are likely to stay the same. If the Senate flips to Democrat, tax rates might go up. Our philosophy in not applying for forgiveness, unless you have something that causes you to go do it right now, like you're selling a business or you have a large equity injection. I have a client going through a transaction right now, and they're selling their business, and their bank said the easiest thing to do, instead of filling out all the paperwork on the ownership change, is just get forgiveness now and call it a day. So that's a case where we're doing this. But we're of the opinion that on the financial statement and the tax return, if you don't lock in forgiveness now, we have the most flexibility headed into year end and later on next year when we're filing that tax return and we're doing those financial statements. Because another thing that plays in here is, for income tax purposes, are you a cash basis account taxpayer? Are you an accrual basis taxpayer? Because you might be accrual for financial statement, but you might be cash basis for tax. So those two dichotomies need to be examined as well. And we still don't know what's going to happen in Georgia in the Senate election. So to me, the best plan is to provide yourself with the most flexibility, which I think comes with not applying for forgiveness. And if you're a betting person, you make a bet, will the Senate flip, won't it? And then you develop your plan based on that. And in the end, if things are taxable, if there's a way to have your PPP taxable next year, if it's even ever taxable, because like we said, there could be legislation making it non-taxable. And I say taxable, I know it's really a reduction of expenses, but it's taxable. It's Cheryl, what do you say? What is it on the tax return?
Bottom line, it's just geography. If it's forgiven and you have to reduce expenses, it's taxable. So, you know, why go through the double speak here? It hits your bottom line. It's taxable under current law.
Meg, what else? What saying do you use?
PPP, we've been building an airplane and flying it at the same time. And as the election has fallen out and everything else and different guidance, we're continuing to keep that airplane in the air, but keep building it. I feel like we're on a Boeing Airbus now is what we're building. Some sort of big airplane.
So bottom line, my opinion and our opinion as a firm right now is provide yourself with the most flexibility that you can, which I think is not applying for forgiveness and leaving things in kind of limbo and seeing what happens. And I think Megan said it best that it was either Megan or Jenna, like, we're programmed, it's first come, first serve with PPP. So rush, go get it, get forgiveness. And I keep saying, time out, calm down, let's relax and make the most intelligent decision we can for us as a business. All right, I'll shut up now. Meg, your show again.
Well, just also one quick comment to add to that. I know the person was concerned about 4/15 tax deadline. There is, extensions available to 9/15 or 10/15. So we kind of have to have a good idea of what the tax bill would be as of, 3/15 or 4/15, depending on whatever your tax due date is. But there is some flexibility in when that tax return is actually due.
I got another question here. If I wait until after January 1st to apply for forgiveness, can I deduct the expenses it was used for on my 2020 tax return? Yeah, what we're saying is that is a possibility depending on whether you're accrual, whether you're on your own cash basis, when do you actually get forgiven? So if you don't have a final answer, then there might be a path to take in that position. And you should take a look at your certain circumstances and work with your tax advisor on that.
We still have a large portion of the presentation to get through. So Corey will look at your questions and try to type some answers. If not, he'll interrupt and go through them because I think we have 3 additional questions there. So I'm gonna, Megan, have you move forward, please.
All right, Jenna, take it away.
All right, I am going to just quickly touch upon some of the financial statement presentation options that we have seen as most common right now. So 2 options, debt or a government grant. So if you are electing to show the PPP loan as debt, it will remain a liability on your balance sheet until forgiven, or meaning the borrower is legally absolved of any future responsibilities, or when the loan is paid off, it will come off your balance sheet. And at that point, When it is forgiven, it would be recorded as a gain on extinguishment on the P&L. If the borrower elects to record it as a government grant, it would remain as a deferred revenue item on the balance sheet until there is reasonable assurance that conditions have been met and the assistance will be received. So the conditions here really are the barriers to recognizing the revenue. So if the PPP loan was spent in accordance with the spirit of the program, so it was used for the appropriate expenses, it was used in the right time frame, the thresholds have all been met. And then the second would be whether the borrower received the approval from the SBA or the lender for forgiveness. So at that point, a business entity would record it as other income or a reduction of expense once those conditions have been met, and a nonprofit would record it as a conditional contribution. So I think at this point, I will turn it over to Cheryl for the business tax planning section.
Hold on, we got one question here, and it relates to what we were just talking about. If the next Congress and administration allows the deduction of covered expenses, non-taxable, what is the likelihood it would be made retroactive to those taxpayers who received forgiveness in 2020 and were unable to deduct expenses under current provisions? Again, this is why we're recommending not filing your tax return. But if this did happen and you filed your tax return and you recognize the income or disallowed the expenses, however you want to say it, what we would do is we would file an amended tax return, making that adjustment. That's a relatively harmless process unless you file in a bunch of states. That could get messy. But hopefully that answers your question. All right, I'll be quiet again now for at least until there's another question.
Great. Thank you. Thank you, Jenna and Megan. What a terrific job. Thank you, Corey, for emceeing. We can certainly see how much uncertainty there is with regard to PPP. And maybe this slide here should really be talking about PPP and not necessarily the election. We had an election a week ago, woke up on Wednesday, had no idea what we were going to do with this presentation here when we were talking about tax planning for year end, because we just didn't know who the president potentially was. And I honestly didn't think that we were going to have an issue with the Senate. But Maria, if you can advance to the next slide. So it looks like we've got the projected winner is Joe Biden, and the House of Representatives is going to stay Democratic. That seems solid, although Republicans picked up a bunch of seats that were not projected. So I think weathermen and pollsters are kind of in the same profession. I guess you don't have to get it right and you still have a job. However, we're here and we need to be able to guide you as to what we should do for year-end planning. And so now we have the Senate. And did I ever think I was going to have to learn what the Georgia rules are to elect a senator? Well, right now, we still have 4 seats that have not been completely determined for the U.S. Senate. Alaska and North Carolina have not been, the votes haven't been finalized, although it looks like they will go Republican. And so in Georgia, interestingly enough, it's unusual to have both seats up for election for a Senate seat. Generally, they're staggered. The reason it's not staggered is the one seat for Kelly Loeffler, probably butchering her name, who's a Republican, replaced a senator that retired early. So we've got 2 Senate seats up. There's looks like in Georgia, you have to have over 50% of the vote in order to be elected for that seat. And neither David Perdue or the other Republican that is leading, right, or Democrat that's leading, Raphael Warnock, do not have the majority vote. So there's going to be an election in January that will determine where the Senate is going. So if the Senate, the Republicans just need to pick up one of those 2 seats in Georgia, and then the Senate will stay Republican. If that is the case, Maria, you want to advance to the next slide? Generally speaking, major legislative changes, tax legislation happens when we have one party having both the Senate, the House, and the presidency. So if Georgia picks, so if one of those seats in Georgia goes Republican, it will keep the Senate Republican. So the major overhauls that Biden had proposed during his campaign may not get passed. So what I thought I would do rather quickly, because we are running out of time today, is just to keep in the back of your mind what some of those Biden proposals were. So even if the Senate stays Republican, it doesn't mean that, you know, there could be some art of the negotiation, which we've seen more gridlock over the last number of years when you have the House and Senate in led by different parties. But currently, we are at historically low tax rates. So the top rate passed by the Tax Cuts and Jobs Act, and I want to mention the individual changes for the Tax Cut and Jobs Act were set to expire at the end of 2025. And the corporate changes were supposed to be permanent. So I've been practicing for almost 30 years. They can say something's temporary and permanent. It's only temporary or permanent to the next Congress and president gets in, and then they change things again. So our top rate is 37%. Biden's goal would be to raise that on people with taxable income of over $400,000. That's what he deems wealthy. You can determine whether you view that as wealthy or not, but that's where the cutoff seems to be. So we'd go from a top 37% rate to a top 39.6% rate. With regard to capital gains and dividends, the current top capital gain rate is 20%. It kicks in at almost 500,000 for married folks. He would eliminate the breaks for individuals with over $1 million of income so that they would be taxed at ordinary rates. So very significant changes. Again, you know, with a Senate potentially going Republican, and of course you can decide on what the odds are of the Senate going Republican. Boy, do I feel bad for those folks down in Georgia. You know what the next 8 weeks of commercials are going to be like? I bet 95% are going to be for that race. But for the itemized deductions, Maria, if you want to advance the slide. The Tax Cut and Jobs Act, the biggest area that they changed besides increasing the standard deduction significantly and eliminating personal exemptions was that cap on the state and local tax deduction, which is limited to $10,000, whether you're married or whether you're single. And that really hurt us here in New York State because we are one of the highest state tax rates plus property taxes, and our deductions limited to $10,000. Now, Biden's goal would be to, the maximum benefit of itemized deductions would be capped at 28%. As a reminder, he's proposing a 39.6% cap. And the SALT cap is not something that Biden had stated was one of his goals, but it's certainly been the goal of both Pelosi and Schumer to get rid of that cap because it certainly hurts those blue states where that SALT limitation has come in. So, you know, there could be some negotiations down the road with regard to that SALT cap. So we might have that elimination at some point, even if the Senate stays Republican. For estate taxes, Maria, if you want to advance. Estate taxes, we have a very generous 11.58 set to go to $11.7 million estate exemption. Biden's goal would be to maintain what was supposed to be the phase out would be potentially he could lower that 11.58 million, and which would be a real hurt is eliminate the step up in basis on inherited assets. So those are things that he had proposed. Who knows where things will go? And we're up to our polling question, Maria.
All right, I think everyone is just about in, so I will end the polling.
Isn't it amazing the number of folks that took advantage of early voting? And it only came into being, what, last year, I think, for New York State. So really amazing. I think it would even be nicer if we had a bigger window. So maybe those lines at the polling stations would be a little bit less in the future. So to wrap it up about Biden's proposals, current law for corporates, for C corporations, they now have a flat 21% tax rate. You may know that the US's tax rates were graduated before the Tax Cut and Jobs Act with a top rate of 35%. It was one of the highest in the entire world. And that was supposed to be permanent. Now, Biden's stated goal would be to raise that flat rate up to 28%. Also, he had talked about increasing the tax on foreign earnings, also known as GILTI, from 10.5% to 21%. So that would be a significant change if anything gets through. He would eliminate or limit the qualified business income deduction for certain high income individuals. And he also, and I don't know if this was aimed at Trump, but eliminate the use of Section 1031 like-kind exchanges for real estate, which is something huge in the real estate market. A lot of times our individuals want to kick the tax can down the road. So they sell one piece of property and they exchange it for something else, and they're able to avoid paying gain or kick the can down the road. The other proposal that Biden had was to increase the Social Security taxes for individuals earning over $400,000. So each person pays Social Security taxes on up to $137,700 wages, and then you pay Medicare tax unlimited. What Biden would do is say you pay $137,700 on the first amount of wages, you get a break, and then if your wages go over $400,000, they're going to kick in that 12.4% Social Security tax unlimited. So very interesting proposal there. Who knows if anything will pass like that. So as you could see with the PPP program and all the uncertainty, we just want to remind you what Biden's proposals were. He is what appears to be the president-elect. So when we're talking about year-end tax planning, we know what the current rules are. Our corporate rates are 21%. New York State corporate rate is 6.5%. Individual top rate is 37% with that qualified business income deduction, which is terrific for our business owners with pass-through entities. And we have a New York State top rate of 8.82%. A couple other things just to mention in passing, we had a presentation about a little over a month ago about the CARES Act. That was what was passed in March and created the fund for the PPP program, but it also had some other great things that were included in it to alleviate, some of to help business owners. So if we have business owners that have net operating losses currently, you can carry those losses back for 5 years, which is great to recoup some of that taxes that you paid in previous years. And the CARES Act also eliminated the, for individuals, there's a excess business loss limitation, which the Tax Cut and Jobs Act put in, and you could only deduct up to, for married individuals, a $500,000 loss from your business on your tax return. That's been eliminated for 2018, 19, and 20. So very great rules for our business owners in very challenging times. To note though, New York State didn't go along with these rules. It was just a little bit too rich for New York State. So what we did see on a lot of 2019 returns is we were able to maybe reduce the federal tax liability significantly, but we ended up with a state tax leakage because they weren't following the CARES Act. So some year-end planning considerations for our cash basis businesses. We always, if we're trying to drive down our tax liability, and when you drive down your tax liability, you're putting cash in your pocket. So if you pay all your expenses or as much as you can by December 31st, those are deductible. You can prepay some of your 2021 expenses as long as they will be incurred in 2021 by December 31st, and you would get the deduction this year. However, if you truly believe your tax rate's going to go up and you're one of those individuals with income over 400,000 and think that some of those Biden proposals are going to come through, you might consider deferring expenses until 2021 to drive down your taxable income in 2021. As a cash basis taxpayer, it's difficult to determine. You don't have a lot of flexibility. You have to make those determinations and pay those expenses by the end of the year. The other key thing that we talked quite a bit about was the impact on PPP forgiveness on your tax liability. If it's considered forgiven in 2020 and under current rules, that would increase your tax liability. If it's forgiven in 2021, that's when your income recognition event would be, and you're kicking the tax can down the road for a year as well. We're hoping that the PPP will be completely excludable from taxable income, because that would truly be a business incentive. So if you think about a client that got a $100,000 PPP loan, if you have to pay tax on it, you probably have $35,000 of tax leakage. If they say it's not taxable at all, that gives you an additional $35,000 of working capital. So that's really what we're hoping for is, you know, the money's already out the door. It would be great if Congress does pass some legislation through the next stimulus bill that will exclude that completely from income. So for the recognition of income, Maria, we can jump to the next slide.
Just
Generally-
a second, Cheryl, there is a question on that.
Sure.
Trump put in a percentage off S corps, not which show up on the personal tax. Is Biden going to eliminate this?
Can you repeat the question?
I think they're asking if QBI is going to be eliminated by Biden.
Yes. So the qualified business income deduction is a 20% deduction. So Biden has said that he looked like he was targeting individuals who his taxable income was over 400,000, that he potentially could eliminate that. You know, right now we know that the current rule is that we have qualified business income deduction. So Biden potentially, you know, if you have a Democratic controlled Senate, that could potentially be, that benefit could be reduced for higher income individuals, it looks like. So for the recognition of income, we try to, you know, for those cash basis taxpayers, you know, the goal is to accelerate expenses and defer the collection of receipts until after year end. You know, sometimes clients, you know, don't check their mail at the end of December and have very big deposits in January of the next year. And, you know, that continually happens from year to year. So if you think that tax rates are going to go up in 2021, you would probably want to make sure that all your receipts get into 2020. You know, and any increased taxable income that you may have for business owners may be partially offset by that qualified business income deduction. So the top rate for individuals is 37%. However, if you're able to take advantage of the qualified business income deduction, it makes your effective rate for federal purposes down to just shy of 30%. Still a lot of tax leakage, but not quite as bad. So for our accrual basis taxpayers, just a couple of thoughts. Accrued compensation, you know, it's deductible if paid within 2.5 months of the end of the calendar year, as long as the all events test. So a lot is met. A lot of times what happens is employers may accrue bonuses at the end of the year and they pay them to their employees in January. So they don't have to the employees don't have to pick it up until the next year, and the corporation gets the deduction. But if you believe that tax increases are coming your way, especially maybe for your high wage earners, you might consider having those bonuses paid by December 31st, when we know that tax rates may be lower. What was interesting is I did a little Google today about, you know, Governor Cuomo and potential tax increases. And he said, well, we really don't want to increase taxes. However, unless we have a huge bailout of the state, we probably are going to have a very significant deficit as a state. So revenue has to be raised somewhere, unless they're going to cut expenses. And historically, New York's not very good at cutting spending. Their usually go-to thing is to raise additional revenue. So one area that we can continue to plan, and you know, we don't have to worry, we have flexibility after year end, especially for our cash basis taxpayer, is asset additions. So if you buy additional fixed assets, generally speaking, we like to deduct as much as we can of those fixed asset additions to drive down taxable income. Even if we have higher tax rates in the next year, the key thing to think about is if you get a deduction in 2020, it's going to put cash in your pocket with lower taxes today. So we do want to plan if there is higher taxes in the future to save individuals as much as we can, but just keep that in mind. So If we do have some strategies for clients, we might want to accelerate depreciation or slow it down depending on each person's situation. So it's very important for you to be talking with your tax advisor here at Lumsden as to where you are for 2020. Consider what the impact of the PPP would be if the recognition event is in 2020 or 2021. Some of our clients could potentially be in a loss situation, so we would want to accelerate depreciation as much as possible, given the very generous net operating loss carryback rules. The other thing with regard to fixed asset additions is you have to make sure, even if you purchase the equipment in 2020, it needs to be placed in service. And we are seeing a lot of supply chain disruptions, so orders are getting placed, but things aren't getting delivered for longer than anticipated. So if you're planning on purchasing some equipment to help drive down your taxable income, it needs to be received and placed in service by the end of the year. The qualified business income deduction we mentioned before, this was part of the Tax Cut and Jobs Act. It's a up to 20% pass-through deduction for the qualified businesses income. One area of planning that we should be looking at is for those businesses that don't have a lot of labor costs. We want to make sure that you are going to be able to take full advantage of the potential 20% of QBI deduction. So we want to make sure that your wages are high enough so that your deduction is not limited. So if you have a business and you cut payroll for maybe your business owners or your high income individuals, because that didn't affect your PPP loan calculations, we should be taking a look at it to see if we should be adjusting those wages by the end of the year, if it makes sense, in order to maximize the deduction. The other thing I want to mention in passing is that a lot of our real estate clients, if you're in the process of selling a building and you qualify for the qualified business income deduction, if you sell that building, if you're by December 31st, you may not receive any benefit of the qualified business income deduction as it relates to that activity. You have to have UBIA. So I'm going to have to read what this is. You'd think after 2 years, I would know what it is, almost 3 years. Unadjusted basis of qualified property immediately after acquisition. What does that mean? If you own a building and that building qualified for the qualified business income deduction, and you sold that building December 15th, and you had $100,000 of rental income, as of December 31st, you would have no UBIA, and therefore your deduction might be almost eliminated for that. So sometimes if you can defer the sale of that rental until that real estate until early 2021, you would be able to get that deduction. So just a planning note, a lot of times we like to get things all wrapped up by December 31st because it makes us feel good and we want to file maybe a final partnership tax return. Sometimes you don't want to rush, especially with if you qualify in that one area. And I think we touched on this. Understand the impact of forgiveness on your PPP loans. So right now, the forgiveness will increase your taxable income. So as Megan and Jenna and Corey were talking, if you don't have forgiveness until 2021, can we take the position, because right now it's as clear as mud, that we're not going to recognize that income to 2021? Well, that defers the payment of tax for an entire year on that PPP forgiveness. So it's really unclear right now as to what's going to happen in this area. There has been so much uncertainty around PPP the entire year, and it's very difficult to make solid business decisions when you have pretty significant PPP loans and how much it's going to impact your business. In my example before, with a $100,000 loan, that could mean the difference of paying $35,000 of additional tax in 2020 or potentially 2021 if the rules currently do not change. So before I turn it over to Bob, and I apologize, Bob, we've kind of run over today. When we're planning in uncertain times, focus on your current rules. We know what the rules are for 2020. Reach out to us sooner rather than later. We are already reaching out to clients, but if you have questions, reach out to us because there's a lot of things to consider when we're looking at timing for PPP and year-end planning. Major tax changes are unlikely unless there's a clean sweep by one party, but don't think there won't be any changes. There could be negotiation that you give me this, I'll give you that. And, you know, although the Tax Cut and Jobs Act changes are set to expire by December 31st, 2025, as with anything with Congress and the presidency, anything that's considered permanent or temporary could change at any time. That's what the current rule is, but don't be surprised if things get changed earlier. With that, Bob, I think I'm going to turn it over to you.
Thanks, Cheryl. So like Cheryl said, seeing that there is some uncertainty still surrounding the election and the Democratic or Republican control of the Senate, I'm really going to focus on things that we do know now and some of the traditional planning strategies that we use. So obviously the key to any year-end income tax planning strategy is to minimize your income taxes. So typically this is done by either reducing the amount of income received, increasing the amount of deductions, or a combination of both, again, like we've discussed. If income taxes are expected to raise in subsequent years, the opposite of this strategy, you might want to consider that. So we can see on this first slide, ordinary income is taxed at 7 rates, depending on the level of taxable income. You'll see on the next slide that the capital gains, the tax on capital gains applies at 3 different rates, also depending on the amount of taxable income. So again, as Cheryl had previously mentioned, the Biden tax plan proposes to roll back some of the income tax reductions put in place under the Taxpayer Cuts and Jobs Act for taxpayers with income over $400,000. Maria, you can, thank you. So with that said, in addition to considering your income tax rates for the year and the decision to either accelerate or defer income, the 3.8% net investment income tax and the 0.9% Medicare tax on wages and self-employment income should also be considered. So as we know, the 3.8% net investment income tax applies to investment income, which would be your interest, your dividends, your capital gain income, when income reaches $200,000 for a single filer or $250,000 for a joint filer. The 0.9% additional Medicare tax applies to wages and self-employed income when income reaches those same thresholds. So if you were to accelerate income in the current year, it's important to be cognizant that it might push your total income over these thresholds, making you subject to these additional taxes that you may not have been subject to previous to that.
And Bob, I'm just going to interject here. Those net investment thresholds and Medicare thresholds have not been indexed for inflation for a long time. So it is more and more folks are paying these taxes than had when they were originally passed. And that was part of the game plan there.
Thank you. So moving on to maximizing and accelerating deductions. So further to what Cheryl had mentioned, the 2020 standard deduction has been adjusted for inflation. And because the standard deduction amounts are so high, it really is difficult for many taxpayers to claim enough deductions to be able to get the benefit of itemizing. So to maximize your itemized deductions, to maybe push you over the threshold, or maybe that you know in a specific year you will have enough to itemize, the first easy strategy would be to make an additional mortgage payment prior to December 31st to capture that extra additional interest. So you'll be making 13 payments instead of 12 payments for the year. You can also prepay your state and local income taxes or property taxes to capture those deductions in the current year. Just remember that this deduction is capped at $10,000 for federal purposes. Typically, it's difficult for most taxpayers to surpass the AGI limitation to deduct medical expenses. But if you are able to do so, accelerating these deductions may push you over the threshold. It's important to remember that the AGI threshold has been reduced from 10% to 7.5% for 2020 only. And then finally, from an itemized standpoint, I'll discuss maximizing your charitable contributions, but I think we have a polling question first. And this will be our final polling question.
I'll give it another second. Looks like it's pretty consistent with people who are across the board. So, all right, Bob, I'll turn it back over to you.
Thanks, Maria. So as we know, the amount of your charitable contribution that is deductible based on an adjusted gross income limitation is dependent on the type of organization that receives the gift. I really won't get into the fine details regarding all the limits. I'm really just going to focus on cash donations, as those are the most common. In years prior to and after 2020, cash contributions have been limited to 60% of your adjusted gross income. Any cash contributions made in excess of 60% of your adjusted gross income can and will be carried to future years as a deduction. Where you can switch the slide. So now in 2020, with the introduction of the CARES Act, individuals may deduct up to 100% of their AGI if making a cash contribution to a public charity. This change only applies to cash gifts to qualified public charities. It does not apply to gifts to donor advised funds or to private foundations. And then for C Corporation, the CARES Act increases the deduction limit from 10% of taxable income to 25% of taxable income. Next slide. So in addition to the increased limitation for those taxpayers who do itemize, taxpayers who do not itemize in 2020 will be able to claim an above the line deduction of up to $300 for cash contributions made to public charities. Unfortunately, there will be no carry forward to future years if those contributions are made in excess of $300. Slide. So looking at the next slide, how do these rules and limits apply from a planning perspective? Again, talking about accelerating deductions, if you have charitable intent, you may want to consider bunching your charitable contributions into 1 year rather than spreading them over a multi-year period as to push you over the standard deduction for the year. Making gifts to donor advised funds very much play into the strategy, as you would receive an upfront charitable deduction while not having to identify specific charities to receive the gifts in that same year, and also allowing the funds to grow tax-free in the donor advised fund account. Making gifts of appreciated stock or real estates with a low cost basis provides you with a double tax benefit of not having to pay capital gains tax on the appreciation of that asset upon sale, while getting a deduction for the fair market value of the assets on the date of contribution. And then finally, from a charitable standpoint, a qualified charitable distribution directly from an IRA allows for a direct reduction of your AGI while satisfying the required minimum distribution requirements for the year. This is limited to $100,000 per year directly from the IRA. It's also important to know that taxpayers are able to do this at age 70 and a half rather than at age 72, which is the new age to begin a required minimum distribution under the Secure Act. So moving on from itemized deductions, maximizing education credits and deductions might also be a great way to lower your adjusted gross income. Without the introduction of any new legislation, the tuition and fees deduction is set to expire on December 31st, 2020. So prepaying some 2021 tuition in the current year may be beneficial for some taxpayers. Also funding a New York State Section 529 account provides a deduction from New York State income of up to $10,000 for joint filers and $5,000 for single filers. The 2020 401k contribution limit is $19,500. So essentially every extra dollar you contribute to a 401k is a direct reduction in adjusted gross income. The same goes for a deductible IRA contribution. The contribution limit is $6,000 for 2020 or $7,000 for those 50 and older. Educators are still allowed a $250 deduction for unreimbursed classroom expenses, which again is a direct reduction in adjusted gross income. And then finally, Roth conversions. So the best scenario for converting a traditional IRA to a Roth IRA is when you expect to be in the same or a higher tax bracket during retirement. There is a tax cost to converting. However, the income and the gains that accumulate in the Roth account and all of the qualified withdrawals will be free of federal income tax. So in addition to that, tying the charitable back, if you have a substantial charitable intent where the charitable deduction will reduce your federal income to zero, which again is only available in 2020, it might be a great time to consider a Roth conversion to reduce or even eliminate the tax costs in doing so. And then quickly touching on estate and gift issues, again, reiterating what Cheryl had said, in some of these respects, the annual gift exemption remains at $15,000 for 2020, which means you can gift up to $15,000 per person without reducing your lifetime gift and estate exemption. The 2020 federal lifetime estate and gift exemption has been adjusted for inflation to $11.58 million per person. It is projected to be indexed to $11.7 million in 2021. However, we know that there is uncertainty based on the Biden tax proposals. If the lifetime exemption amount is reduced in a future year, the IRS has announced that it will not claw back any gifts made in the years in which the exemption was inflated. So for example, if you made lifetime gifts of 10 million and the exemption reverts back to 4 million, those additional $6 million in gifts will not be pulled back into your estates. And then finally, it's important to remember that gifts made directly to educational or medical institutions on behalf of another individual are not considered part of your $15,000 annual gift or part of your lifetime gifts. So these direct gifts right to those institutions can be made with really no tax impact.
So we got a question that came in, and also just if anybody has any last minute questions, because we're pretty much done here, please submit them now. So this is a question, while we have Bob on, here's an estate question. For estates, do gifts have to be given to relatives if you have no direct heirs?
They do not. So gifts can be made to relatives, non-relatives, charitable beneficiaries, really anyone that you designate.
Thank you, Bob. And now we have a question for the PPP team. Company with a PPP loan subleases building from holding company with no PPP loan, which leases property prime lease from our town. Do rent payments from sublease qualify for PPP loan forgiveness?
So right now, if there is a lease agreement with your related party and the lease agreement does not have a PPP borrower and the town's name on it, it has the PPP borrower and the related party, I think you're going to fall under that, the rule that it has to be mortgage interest, and that's the only amount that you can get forgiven. Unfortunately, this guidance was not super clear, and it was kind of not super friendly in terms of if there's no mortgage, then you're kind of out of luck, unfortunately. Jenna, do you agree with that? Yeah, okay.
We got another one now. Why does the PPP application ask for the number of employees at the time of forgiveness application?
So I think that's just kind of like an informational question that the SBA wanted to know, kind of more like demographic information about, or kind of how companies are doing, you know, after the PPP period.
Cool. Any other questions coming in? We do not. So with that, I think we're wrapping up, and I want to thank all of our panelists today for coming on and giving this great information. Hopefully people enjoyed the presentation, learned some, or at least have a better idea of what questions they need to ask and have answered heading into year end. And like we said, I think flexibility and calm planning is probably the way to go. And with that, I hope everyone stays happy, healthy with everything going on. And I'm sorry, I hope everybody saw my t-shirt in the background, but I want to show them. I will do taxes for beer, just to let everyone know. So headed in for a year in planning. If anybody wants to buy me beer, we can talk. With that, thank you from Lumsden McCormick and our team. Have a good day and stay safe.